the second part of the video lecture for chapter 3. In the first part, we talked about adjusting entries. In this second part, we will conclude the chapter and talk about closing journal entries as well as the post-closing trial balance, right? So, what I will actually start with, we're done with adjustments. I'm going to talk very briefly about adjusted trial balance and financial statements. So I'm continuing our travel through the steps of the accounting cycle. So we're done with adjusting entries. That's what we did in part 1. So right now we're going to prepare an adjusted trial balance, and then we're going to prepare financial statements, and then we're going to close accounts. We will have 4 closing journal entries. This will be your last 4 journal entries, and they also have to be posted to the ledger. And then we will prepare a post-closing trial balance. We're not going to do reversing entries. Also, guys, in this chapter, I will talk about the classified balance sheet and its components, and I will cover 2 ratios, the profit margin and the current ratio. So let me go to where we left. Right here. So we stopped right here. So let's continue, guys. So after we recorded, journalized, and posted the adjusting entries, we're gonna prepare the adjusted trial balance. So this trial balance reflects balances after adjustments. And then, guys, based on the adjusted trial balance, we're gonna prepare financial statements. I'm not spending much time here because you already know how to prepare your financial statements from chapter 1. So we're going to take revenues. This is a revenue right here. And we're going to subtract expenses. And we're going to have, this is total expenses. And we're going to have the net income. So that's the income statement. The second statement is called the statement of retained earnings. We're going to take the beginning retained earnings, 45,000. Plus, we're going to transfer the net income that we just calculated on the income statement, minus dividends, here they are, gives us the ending balance of retained earnings. So notice here, I made profit of 15K, but I paid dividends of 20K. So my overall retained earnings decreased by $5,000. And then, guys, we're going to use this ending December 31st, 2017 retained earnings to prepare the balance sheet. And on the balance sheet, we list your assets. You have only 3 assets. Here they are. Total them up. Then you list your liabilities. You have 2 liabilities. There they are. And you have 2 equity accounts, common stock. And notice, I do not use retained earnings from 2017. I have to use, I don't use this retained earnings from the adjusted trial balance. I use retained earnings from the statement of owner's equity. Here we go. And guys, notice I am in balance, hence the name, the balance sheet. Total assets equal to total liabilities plus equity. Okay. Next step, after you prepared financial statements, we're still not done. We have to get rid of temporary accounts. To do so, we're going to make 4 journal entries. So all of the accounts, if you think, I'm going to write down right here our fundamental accounting equation. So the short version is assets equals to liabilities plus stockholders' equity, right? These are permanent accounts. Your cash, your accounts receivable, your supplies, your accounts payable, your long-term liabilities, your common stock, your retained earnings, they're permanent because we're gonna roll them into the next period. They are ready to go. We don't need to touch them. So they're called permanent or real accounts, and they are rolled into the next period. Their balance goes on and on and on. But then, guys, what we did with you in chapter 1, we actually separated these 3 temporary accounts from equity. We separated revenues minus expenses minus dividends, and this red, we had to keep track of it separately so we would know what my net income and change in retained earnings are. Well, now we know it. We already prepared financial statements, so I don't need them. I'm going to get rid of them. So they're called temporary or nominal accounts. I want to start a new period with zero in revenues, zero in expenses, zero in dividends. A reason? Because I want to know my net income for the next period, just for that period. I don't want my net income from this period to impact it. So what we're going to do, we're going to close them, hence the name, the closing process. We're going to bring them down to zero. We're going to empty them out. So guys, these are your journal entries. What I'm going to do, these are 4 journal entries. There are 4 steps. In the first step, you close revenues into this new account called income summary. You haven't seen it before. Second step, E, we're going to close expenses into the income summary. Third step, I, we will get rid of income summary. And the last step, D, we're going to close dividends. So the last 2 steps are closed into retained earnings. And guys, retained earnings is the only permanent account here. So instead of doing this, let me guys use an example. This is the adjusted trial balance that you have in the slides. So I just copied it right here. And I want to use T accounts because they're more visual, okay? So first of all, guys, I'm going to find dividends. And I'm going to say that the only accounts that I have to close are actually starting from dividends and lower, right? So I will have to close revenues, which is fees earned, expenses, and dividends. Everything above dividends we don't touch. They're permanent accounts, and the only one that will change is this retained earnings. Remember that it has to go from 45 actually to 40,000. So the first step, first journal entry, R, right? The first step, let me go right here, R, close revenues into income summary. I have one revenue account. It has a credit balance. Oops, sorry about this. It has a credit balance. So it has a credit balance. How do I get rid of it? I just offset it. I need to debit it, decrease it, right? To make it zero. I'm artificially making it zero. This is my first step. What happens with the balance? It becomes zero. So I need to debit my revenue account. But if I debit something, I have to credit something. So I introduced this new account called income summary. I think of it as a trash can. You know, I temporarily throw revenues and expenses in there. So if I debit revenues, I'm going to credit income summary right here. So this is my first step. I move my revenue from the revenue account into income summary. Debit revenue, credit income summary. Now I can go back to your slide and that should make sense, right? We're going to debit, and let me put it right in here, the amount, 79,000. I'm going to debit 79,000 right here, fees income. So you'll say fees income actually, right? And guys, we might have more than one revenue account. So if I have more than one, I will debit all of them and I would credit income summary by the total revenues. First step. Second step, I need to get rid of expenses. We have 2 expense accounts. I put them right here. Salaries expense, office supplies expense. You might have 100 expenses. We need to credit all of them. Why do we credit them? Because it makes the balance zero, right? We're going to offset the balance, the debit balance. So I'm going to credit them. Well, what do I debit? I debit income summary. What's the amount? Total expenses. Total expenses. So where does the 64,000 come from? It's salaries expense plus office supplies expense. So my second step, right? I debit income summary, $64,000, which is my total expenses. So I will actually list expenses separately. So I have the salaries expense, $56,000. And I have, let me go right here, and I have, office supplies expense, $8,000. Office supplies expense, so I'll say right here, supplies expense, $8,000. And if I have 10 expenses, I credit all of them separately. Guys, where does it go from the journal? All of this are posted to the ledger, right? You post all of them to the ledger. So as a result, my fees income and my expense accounts are zero. Okay, let's look at income summary. You know, I've used it. So let's see what my balance is. Credit represents revenues. Debit represents total expenses. My balance here is going to be 15,000. What is 15,000? That's net income, right? This is the amount of net income. Hence the name income summary. And guys, again, if I go back to my slides and I will show you, you know, right here is 15,000. I know that net income is $15,000. Okay. So I don't need this account anymore. This trash can has been used. So I have to get rid of it. How do I get rid of it? I debit it, right? I debit it. What do I credit? Well, I move it to retained earnings and think about it. It makes total sense. What does net income do to retained earnings? It increases it. How do you increase retained earnings? You credit it. So guys, with the income summary, we could have a couple of different scenarios. The scenario that I'm showing to you here is, let me make it a little smaller. The scenario that I'm showing to you here is an example of net income, right? So we have income summary has a net income of $15,000. By the way, if you're not doing T accounts, how do you know it? Well, look at the credit, 79, and look at the debit, 64. The credit is larger, that's revenue, minus 64 gives you 15. Where does it go? It goes as a credit, which is a plus, right? Net income increases retained earnings. That's the scenario we have. In some other examples, you might have a net loss. If you have a net loss, then it will work out. You will debit retained earnings, and it will be a minus, right? Retained earnings have minus, plus, and income summary to make it a zero, you will have to credit. Okay, the last step is dividends. My dividends is $20,000 debit. How do I make it into zero? I credit by the same amount I offset and my balance becomes zero. This is my last transaction. If I credit dividends, what do I debit? We debit retained earnings, which makes total sense. Just a second, I'm sorry. It has to go like this. So because dividends decrease retained earnings, right? And what's my new balance? My ending balance is now $40,000. That's the EB ending balance, and that's what goes on the balance sheet. We already talked about it. So out of all of these accounts, guys, everything is gone, right? Salaries expense, supplies expense, dividends, income, and fees earned, everything is gone except for retained earnings. All of those transactions are rolled into retained earnings and are reflected in its ending balance of $40,000. So the last journal transaction, we took $20,000 debited retained earnings, I'll say minus, right? Dividends decrease retained earnings, and we credited 20,000 dividends, which is also minus, and it brought dividends to zero. So let's practice more. I hope it makes sense. Let me guys go to quick study 3-21 on page 143. 3-21. Here we go. Prepare closing entries. The ledger of my company includes the following accounts with normal balances. Common stock. I don't know why they give me common stock. I don't need it. Just to confuse us. Dividends, services revenue, and 2 expenses. Prepare necessary closing entries. So the first step is to close revenue accounts. I have the service revenue 13,000. So I'm going to say service revenue 13,000 debit, makes it a zero because the normal balance is credit. Where do I move it? Income summary. That's your first entry. record entry. Second entry, I have to get rid of expenses. I'm going to move them to income summary. I don't know what the amount, and there are two of them. There is wages expense, $8,400, 84, credit, normal debit balance, I credited to make it zero, and rent expense, 1,600, 1,600 rent expense. Okay, after I listed them, I add them together, that's $10,000. All right, record. Okay, let me look at the first and second entry. So income summary, credit 13,000, that's revenue. Second step, total expenses are minus 10. So what do I have? Net income or net loss? I have net income of $3,000. So what's my third step? Third step, close out income summary into retained earnings. So I'm going to debit income summary. I'm going to credit retained earnings by $3,000. Again, do not touch common stock or anything else. It's the difference between the first and second step. It's net income, right? So it has to increase retained earnings. How do we increase retained earnings? It's minus plus. We credit them. Record. And the last one is dividends. So my dividends here are $800. I'm going to decrease retained earnings, $800. And I'm going, because it's minus plus, and I'm going to credit, oops, come on, dividends by $800, recorded, and we are done. This is my journal entries. Close revenues, expenses, income summary, and dividends. So please practice. I hope it makes sense. And let me finish the chapter. So the last accounting step is to prepare this post-closing trial balance. I just want to list only permanent accounts, right? I don't need revenues, I don't need expenses, I don't need dividends because they have zero balances. So the post-closing trial balance only includes permanent accounts. Anything, it's anything starting with retained earnings. If you look on the bottom, the last account will be retained earnings. And all accounts above it, just your assets, liabilities, and equity. So we will list permanent accounts, their balances, debit or credit, and then my debit column has to be equal to the credit column. So here is an example. This is a different example from your textbook, not the same one we were using before. But again, look, what's the last account? Retained earnings, right? Assets are debits. You see that? All the assets. And now we have contra asset. That accumulated depreciation has a normal credit balance. It's minus plus. Contra asset. You have liabilities. These are three liabilities. Remember, unearned or payable makes it a liability. Anything with the word payable or unearned. And you have two equity accounts. And my debit column is equal to my credit column. That's the last step of the accounting cycle. So these are the steps, 9 steps. Again, as I said, we're not going to do reversing entries in this class. They're not necessary. We finished the cycle. And guys, we did the accounting cycle for a service corporation in the first 3 chapters. Well, in chapter 4, we will do the accounting cycle, same steps, for a merchandising business. It's just going to be a business that now will sell tangible goods instead of services, so it will have more accounts. But the idea and the cycle and the steps will be the same. Okay, a classified balance sheet. So instead of just saying assets equal to liabilities plus equity, right? We need more groups. So we're going to take our assets and we're going to divide them into these 2 large groups, current versus long-term or non-current assets. And then guys, non-current, so current assets, anything that will be used up or converted into cash within 1 year. Non-current assets, anything that we will be using or converting into cash in more than 1 year. And guys, we can subdivide non-current assets into these groups. Not every business does it, but that's how we're going to do it actually in chapter 8. You will have long-term investments, planned assets. And guys, planned assets are tangible and intangible assets are intangible, such as brand name or patents or copyrights or leases or your domain name, things like that. And guys, liabilities are subdivided into current liabilities. What is your debt that you have to pay within a year? Think about your mortgage or your car loan. Your car loan could be 5 years, but how much of that do you have to pay within a year? So that portion is your current debt. And non-current is everything else. Whatever you owe, if your mortgage is 30 years, current mortgage, current liability is what is due within 1 year. Everything else is above 1 year. So, and guys, these subgroups we're going to be using, dividing into each other to come up with different ratios, which are very useful to make analysis and decisions about the health of the business. And guys, equity is not subdivided. So I put here on this slide all definitions of all different groups. And guys, so instead of looking like this, your classified balance sheet will look like this, right, with different subgroups. And one of the ratios, let me actually go skip this one for a second. One of the ratios we're doing in this chapter is called the current ratio. So instead of looking at all assets and all liabilities, we take current assets and divide by current liabilities. What does it show? It shows to us if the business has enough cash or near cash items to pay its bills. Does the business look good enough to pay its short-term debt? And short-term debt is the bills, right? Do they have enough cash or near cash? Because current assets are those assets that will be used up or converted into cash within a year. Now, a rule of thumb here that if this factor, current ratio, if it's more than 2, then the business is doing well. And guys, mostly lenders are looking at this, right? Lenders. Like when you and I apply for a loan, they calculate the current ratio for us. And the higher the current ratio, the more chance we will get to get a loan. We're less risky and we will get a better interest rate. Why should it be 2? So for every dollar of debt, short-term debt, we should have $2 of current liabilities. Guys, current assets, I'm sorry. Because not all assets will convert into cash. We will not sell all inventory. We will not convert supplies or prepaid expenses into cash. So more than 2 is good. If it's between 1 and 2, we're not sure how the business is doing. So we will be calculating a stricter ratio, which you will study in chapter 4, and it's called the acid test ratio. And if it's below 1, the business doesn't have enough assets, current assets, to pay for its bills, so the business is risky. It's not doing well, and the company's financial management has to come up with missing money. So you can see here throughout the years, right, limited brands, you can see that it was doing really well in 2010, and then current ratio decreased, which is a negative trend, and then starting from 13, it started increasing. And another way of measuring, of analyzing it, is to compare it to industry average. This is industry average, and you can see that the company right now is doing a little bit better, which is a positive sign. So that's the current ratio. Guys, another ratio here is a very useful one that has to do now with profitability. So we take net income and divide into net sales. Guys, if you think about the income statement, we take the bottom number and we divide into the top number. And guys, it's expressed as a percentage. I like to think of it as cents. So if you look at 2011, my profit margin is 8.4%, which means that for every dollar of sales, the company makes 8 cents in profit, 8.4 cents in profit. So if I spend $100, the company will keep $8.40 as profit, and the rest are costs and expenses. So this one we want to be higher. The higher the better. And you can also compare to the industry. You can see that limited brands is doing much better than the industry average. And then you can also compare horizontally across time, and you can see it went down and then it went up. And it's actually right now doing quite well with 9% profit margin. Guys, it depends on the industry, right? If you look at Walmart, if you look at 7-Eleven, if you look at a grocery store, they turn over their inventory very fast. So they can survive with very low profit margins. You know, a couple of 2, 3, 4% profit margin is fine. But if you look at the business that sells jewelry or anything customized cars, expensive furniture, anything more expensive, then the profit margins will be much higher because the turnover is much lower. Thank you for your attention. This concludes chapter 3.